Welcome to Tradewinx software. Diversifying your portfolio. 1. Invest in several industries. You may have heard the cautionary phrase, "Don't put all your eggs in one basket." This caution applies to investing, especially long-term investing. Even the safest stock can become too much of a risk if you put all your investment dollars into one company or even several companies in the same industry. When you put all your investment dollars in one place, the value of your investment will rise and fall with the health of that single company. You also want to balance between high-growth industries and industries that grow at a slower, steady rate. For example, you might want to invest in the tech industry, but also in electric utilities, which offer a dramatically slower growth rate but are less volatile and more predictable. 2. Include at least a few recession-proof stocks. Particularly if you're investing for the long term, you want to include stocks in your portfolio that will continue to perform well in a turbulent market. This way, in the event of another recession, you won't be at risk of losing everything you've invested. For example, no matter how bad the economy is, people still need food, and people will still get sick. Investing in food and grocery companies, as well as in the medical sector, can ensure your portfolio doesn't take too much of a hit in the long term if the market crashes. 3. Diversify threats as well as industries. Some threats can have a negative impact on several different industries. To use diversification effectively to protect your investments, make sure you're not investing in industries that share similar threats. On the other hand, a threat that has a negative impact on one industry could have a positive impact on another. Having stocks in those two industries would be effective diversification, because when one fell the other would rise. For example, a war in the Middle East could wreak havoc on the oil market. However, increased demand for military hardware could at the same time strengthen the steel industry. 4. Avoid casting your net too wide. While diversification is a good thing, too much diversification will blunt the purpose behind having a diversified portfolio in the first place. You'll get more out of your investments if you invest sizable chunks in each industry. Keep your investments relatively even so diversification will work for you. For example, if you invest 20% of your total investment dollars in Chevron oil, invest another 20% in a different industry that counterbalances the oil industry. You would then have room to put another 30% in recession-proof stocks such as health or grocery companies, with 10% left to play around with. Give us a call +918 3910 94408. Register now www.stockbuysellsignal.com.